everyone, and welcome to this episode of your Freedom Hubs Working Group. I'm your host, Jeff Cantor, along with my co-host, Charles Froman. We have a number of great sponsors that we'll share with you, and also want you to realize that this is the place where all the activists and entrepreneurs are trying to congregate and disrupt for a much better world, to be sure. We are archiving all these videos, and you will find them on any of these key channels. And if you haven't already, you can use this topmost link to register yourself to get notices every week. And these videos get posted over the weekend. So typically by Monday morning, you can come to any of these and see this and any of the past videos that we've done. Just to give you a little flavor, this is the site where we're showing some of the ones we've done in the past. And it's an awful lot of very compelling ones. They go back a long time. But interestingly, the bulk of them, you could watch a 2-year-old one. You think we recorded it yesterday, because there's some really, really fantastic stuff that really remains timeless, I have to say. Before we get in today, just to point out real fast, we are having some sponsors, as I indicated, and what we're on the prowl here always, just like we're having a guest today, the same mentality. We're trying to find the most important, the best individuals or people or products or services to kind of help the consumers who's bombarded by everything and doesn't get the chance to vet a lot of things to find out what's out there. And so what we have found here, because this is a hot area, is hemp, and it is becoming more prevalent, that this is a bioactive and bioenergetic product, and they're giving us some special pricing to our members if you go there and use this particular code. So just to be aware of that. Now for today, though, let's talk about what we're going to do today and who's going to be guesting with us. And I'm going to give Charles the honor of doing a little presentation as to who's here today.
A dozen years ago, after the Great Recession collapse in 2008, a lot of people lost trust in the stock market and scrambled to educate themselves on ways to hedge and diversify. And given my long time libertarian experience, someone had referred me to Adrian Day, and I learned about some others too, like Peter Schiff, who were focusing on transferring investments to foreign companies that paid dividends, companies that dealt with commodities and resources. And Adrian Day is known as one of the best of these investors and advisors, and he runs Adrian Day Asset Management. He is the author of books like Investing in Resources and Investing Without Borders. Frequently at Freedom Fest, Mark Skousen's annual Vegas event, Adrian has a booth or is featured on the panels as the guy for that kind of investment diversification. So here we are now with the popping of the bubble, as Peter Schiff and others say it's been aggravated by the COVID lockdown. Either way, people are worried again, and who better than Adrian to advise us on what to do?
Very, very good. All right, and on that note, I'm going to convert you to the presenter.
I'm going to talk today primarily about the gold market. We're going to talk a little bit about the background, talk a little bit about the Federal Reserve and what's driving gold. And then I'm going to talk for most of the time about gold equities. One of the questions I get a lot, the gold stocks have more or less doubled since the end of March. Many of them done better than doubled. A lot of people are asking if it's too late. Have we missed a move? So I'm going to address that as well. And then at the end, we'll have plenty of time for questions. So gold during times of crisis was the topic that I was given. But that's a pretty good broad topic, so we can talk about pretty much anything to do with gold, I guess. So there we go. So the most important thing, this is interesting. We don't see the little bit at the right. Does everybody see the whole graph there? This is a graph of the Federal Reserve balance sheet over the years. Obviously, you can see in 2009, we had what at the time was a huge increase in the balance sheet, but in retrospect, really just looks like a little blob. And the main point that I want to make is what we're seeing now with the Federal Reserve and its policy has very little to do with COVID. Here is a picture, here is a graph of the increase in the Fed's balance sheet from September '09 to the end of February this year, before COVID became an issue in the United States. And that may not look as though it's a huge increase. In actual terms, it's actually quite a significant increase. But more importantly, here is the rate of change. And before COVID hit these shores, as I like to say, when COVID was simply a Mexican beer, when COVID was simply a Mexican beer, the Federal Reserve was already increasing its balance sheet at the fastest rate ever. Now, this sort of policy over the years and the last quarter century has really been when the Fed's extreme destructiveness started. It has lots of consequences. One consequence, of course, is that it destroys the purchasing power of the dollar. And this graph is really stunning. And it's an answer to anyone that you may know that doesn't like gold. I mean, theoretically doesn't like gold. This shows you the decline in the purchasing power of the dollar from 1913, when the Federal Reserve came into existence. The dollar has lost 99.6% of its purchasing power in little over a century. What's significant is to put this in context. From the end of the Civil War in 1865 until the dawn of the Federal Reserve, the purchasing power of the dollar was actually flat. It was static. So one can, I think, not just, that it's not just a coincidence, it's cause and effect. The Federal Reserve's policies have led directly to the decline in the purchasing power of the dollar. I'll say one other thing before we move to gold, and that is with regard to the S&P. This table here shows you the peak to trough performance of the S&P during recent recessions, or recent recessions. You can see the blue line there. The S&P dropped just over 30%. And in fact, it was the most rapid 30% decline in the S&P ever on record. So that's one thing. But in terms of absolute numbers from peak to trough, what we saw in February, March was actually very modest. And if you look at some of those periods when the S&P went down more, like at the end of the 60s, November 73, yes, that was a pretty severe recession. March of '01, we've all forgotten about that recession. December '07. I mean, I would argue that the extent of the economic damage we've already seen and the extent of the economic damage that is likely in the period, in the quarters ahead, especially if we get the so-called second wave, I think that dwarfs what we saw in all of these previous recessions. And yet the S&P's performance has been, I won't say relatively mild, but it's certainly not the most extreme, and it was certainly very, very rapid, and the recovery very rapid. The point I'm making here, I don't think we've seen the lows in the S&P. Now, we all know why the stock market is going up. It's going up for the same reason gold is going up. It's going up because the Fed is pumping excess liquidity into the system. Excess liquidity, by its nature, by definition, is liquidity in excess of the needs of the economy. So if you have excess liquidity, it has to go somewhere. It can go into the stock market, it can go into housing, it can go into art and Ferraris and anything else. But since March, most of that excess liquidity has gone into the stock market. That's what's really driving the market. There are some people who think that the economic recovery will be a lot quicker and sharper than people fear. Yes, there's some people who say, oh, you know, the worst is behind us, let's look forward. Okay. But with the stock market that today is trading at 25 times forward-looking estimates, those forward-looking estimates have already been cut, right? They've already been reduced. These are analysts' expectations of earnings looking forward for the next 12 months. And yet the market is trading at 25 times forward earnings. 25 times earnings is high in the best of circumstances. But with the uncertainty we have today, with the economic damage we have today, I would say it was grossly ahead of itself. The same, incidentally, goes for Europe and many other countries. European analysts have cut their forward-looking estimates, their annual estimates, by 12%. Now, I don't know about you. I would be extremely surprised if all we see in the next 12 months is a 12% decline in the earnings from 2019. I would be very surprised. So that's a little bit of background on the market. We can talk about it later if you want. A little bit of background on the Fed. I mean, just in case I wasn't sort of clear, what the Fed is doing right now with what's called QE infinity, which in the words of Fed head Jerome Powell, there are no red lines. He has said that. There are no red lines. There is nothing, this is Jerome Powell, there is nothing the Federal Reserve is not prepared to buy. Now, in that kind of environment, and with that kind of policy, in quotes, gold can only be a winner. And I think one more thing on the Fed, if I may, before we move on to gold, and that is that the Fed has proved itself over and over again that it lacks the will and the determination to draw back, to normalize after crisis events. So we saw that particularly clearly in 2008, when we had QE1, followed by QE2, followed by QE3. As early as 2014, right, which was 6 years after the crisis, but as early as 2014, the Federal Reserve, then under Ben Bernanke, said that they intended to normalize, right? It was 2 more years before they made their first half-hearted attempt to shrink the balance sheet. And within 12 months, they were back to increasing again. The Fed has demonstrated that it cannot pull back and normalize. And there's a wonderful quote, I forget the guy's name, but he was the chairman of the First Chicago Bank, which probably doesn't exist anymore. The First Chicago Bank in 1913, when they were discussing the Fed. And after a few months, he said the elasticity of money under the Fed is like chewing gum, not an elastic band. In other words, you can stretch it, but it never springs back. And that's exactly what we've seen in the last 10 years, frankly, in the last 25 years, but increasingly in the last 10 years. So the first thing I want to sort of demonstrate or suggest is that gold and gold stocks, despite the very rapid moves we've seen in the last 3 months, and in fact over the last year, remain very, very inexpensive. This is a graph of the S&P against gold going back to 2008. And you can see that although gold's gone up, it's still significantly lagging financial assets. So number one, gold remains cheap relative to financial assets. It remains particularly inexpensive when you look at what the Fed is doing to the money supply. Secondly, gold stocks remain undervalued relative to gold. We can talk for hours about that, but this goes back to my eyes. This goes, gosh, I can't even read that. That goes back to something like 1995, I think. And you can see that for 15 years, gold and the gold stocks went more or less in tandem. Gold stocks had more leverage. They moved up more on the upside, more down. And this graph is adjusted for that. So for 15 years, they moved more or less in tandem. But since 2010, 11, they have diverged dramatically. There are reasons for that, some good reasons. We can discuss it, or we will discuss it in a minute. But nonetheless, the point I'm making is just as gold itself is undervalued relative to financial assets, so too are gold stocks undervalued relative to gold. Gold stocks are also very, very cheap on price. Again, even though they've more than doubled in the last 4 months, they are still on a historical basis quite cheap relative to where they were last time gold was at $1,900. And this graph is for the XAU, by the way. The XAU is excuse me, the index of North American gold and silver stocks, gold and silver mining stocks. So you can see that even if we only went back to where we were in 2011-12, there's still a lot more room for gold stocks to move up. More importantly than price, though, I'm sorry, this is another graph demonstrating price. This is an astonishing graph. This is the XAU going all the way back to 2003, I think. No, to 1986, sorry. 1984. Sorry, my eyes aren't that good. This is a graph of the XAU all the way back to 1984. For almost 30 years, gold stocks are basically where they were 30 years ago. Now, again, there's lots of reasons for that, and we can discuss it. But just imagine that. I don't know many other sectors where you can say that they are cheaper today, lower priced today, than they were back in 1984. The point again, with gold at $1,900 as opposed to gold at $300, I think we still have more room to go. So they're cheap on price. More importantly, they're cheap on valuation. And typically, by most valuation metrics, gold stocks today are in the lower quartile in terms of their historic valuations. Clearly, after the move we've had in the last 3 years, and particularly in the last 12 months, excuse me, no one's going to suggest that gold stocks are screaming, they're on the bottom, they're screaming bargains at current valuations. But they are still in the lowest 25 percentile. And but interestingly, as you would expect, when the price of gold moves up, right, typically the valuation metrics tend to expand. So PEs go up, price to book value goes up, price to cash flow goes up, etc. That's not an unusual kind of phenomenon. When a market's strong, you get multiple expansion. And so at $1,900 gold, you would expect the gold stocks to be in the highest quartile. And frankly, if they were in the highest quartile, I would still be making a strong case of them based on where I think gold's going. But to have the gold stocks in the lowest quartile in the current environment, to me, simply demonstrates how cheap and under-owned they have been for so long. So they've doubled in 3 months, but they've got a lot of catching up to do. This is another one to show the same sort of thing, cash flow, still beneath the average, the long-term average. And even on yield, which is interesting because gold stocks today yield the same as the S&P. Nobody historically has gone, well, that's not true. For the last 25 years, nobody has gone to gold stocks looking for income, looking for yield. Now, we did in the 60s and 70s with the South African gold stocks. That's a different story. We can talk about it if you want. But since the South African, since all those mining houses sort of merged all of their individual mines and they became mining houses like Anglo and Goldfields and Harmony and so on, they don't pay decent yields anymore anyway. So basically for 20, 30 years, no one has looked to gold stocks for yield. But today the gold stocks are increasing their dividends based on higher gold prices, the ability to pay higher yields, but also based on investors for 5 years saying, we want a return, we want a return. And so the yields, the dividends have gone up, and they're comparable with the S&P, and yet even there, on a 20-year basis, we're selling very close to all-time lows. I think it's instructive to go back. I'm a historian by training. It's instructive to go back to 2008, which is, you know, the nearest analog, both in terms of time as well as in terms of the economy and what the Fed's response was. It's by no means a perfect one. You can see here that for some peculiar reason, gold is in black and the S&P is in gold. So if you think that's peculiar, write to my assistant who made the graphs. No, I'm joking. So you can see here the black line is the gold stocks, remember. You can see here that from July, the gold stocks started falling long before the S&P did, which is not unusual because gold tends to be a more informed market. It tends to look forward a little better than bonds or stocks. So gold stocks started declining for S&P, and look at that. From July to the bottom in October, third week of October, gold stocks were down about 80% in those 3 months. Astonishing. Then look at what happened. You had Lehman, and the gold stocks started recovering, and the gold stocks were already up over 100% by March. The gold index was up over 100% by March before the S&P bottomed. Now, this time is a little bit different because the S&P has gone up as well, of course. But what happened after this, of course, is that the gold price went on for 5 years to all-time highs, and the XAU went up, you know, fourfold in that period of time. So one can never say, even logically, let alone the SEC doesn't let you say, but things are going to repeat. But I think Winston Churchill once said, the past may not be a perfect indicator, but it's the best indicator we've got. So again, I think anyone who thinks that this is all, you know, we've had 100% in the gold stocks and that's all, is completely missing the point. In 2008, they went on to double and double again after that initial doubling. Let's just talk a little bit about mining, if we may, and this goes to why the gold stocks were so weak from 2011 to 2015-16, apart from the fact that, frankly, they moved too far in 2011. But mining is an inherently difficult exercise. One of my friends, well, some of you will know him, Robert Friedland. He's a mining entrepreneur, very famous. He says Murphy likes to work overtime in the mining business. Whatever will go wrong, whatever can go wrong will go wrong, and lots of things that can't go wrong also go wrong. But the main issue with mining is the ones I've listed here. First of all, you have reserve depletion, and that's really important for people who come from different backgrounds. When, you know, if I'm manufacturing widgets and there's an increased demand for my widgets, well, I just go out and I order more, whatever you make widgets from, and I hire a few more people and we ramp up production of our widgets. When you're mining, whether it's gold or anything else, every time I produce an ounce of gold, that ounce is gone. I've got to find another ounce just to stay static, not to grow, just to stay static. And in fact, not really an ounce. I've got to find a little bit more than an ounce because you always have waste and you always have, you know, when you're mining, you might only get 90% of the gold that's in the ore. So you have to find, for every ounce you produce, you have to find a little bit more than an ounce. So that's the first thing. And along with that goes the fact that we have very few new discoveries. For the last 20 years ago was the peak in new gold discoveries on a worldwide basis. And for the last 20 years, even though part of that 20 years includes the highest gold price yet, right? And even though the amount of money spent on looking for gold on a worldwide basis has not gone down, has not moved very much at all. So despite looking for it, we simply are no longer finding as much gold as we did. We are not finding large deposits, which is critical. I'll come to that in a second. But the key point here is we are finding year after year after year, we are finding fewer ounces than we as an industry are producing, right? And that leads to certain things that we can talk about. It leads to this merger and acquisition sort of frenzy that we've seen, and I think will only get get worse or better, depending if you own the stocks that are taken over. I guess you could say it will only get better, but it'll only continue. Because if you're a large mining company like Newmont, for example, or Barrick or Goldfields, and you're producing between 4 and 6 million ounces a year, right? 4 to 6 million ounces of gold per year. And your hurdle rate for a new deposit, to bring a new deposit in for your company, your hurdle rate is something with 5 million ounces of reserves, which means about, 300 to 500,000 ounces of production per year minimum. There simply are not enough. There simply are not enough discoveries of that size for the major companies. So they have to go out. If they want to stay where they are, not grow, just stay where they are, they have to go out and acquire those deposits, not discover them. Another issue in the past, and this was certainly true, well, it's normally true, that is, as the price of gold goes up, typically, so too do the price of other commodities and the price of what we call the commodity currencies, the currencies of countries where most mines are located. So Canadian dollar, Australian dollar, South African rand, Brazil real, etc., Chilean peso, Brazilian real. All of those countries where most mines are located, when the price of gold goes up, so too does the price of copper, zinc, oil, so too do the commodity currencies. What that means is that the margin expansion on higher gold prices is not as great as one might initially think it is. And in fact, from 2004, I was going to say this might be something for your pub night quiz, but maybe not. From 2004 to 2008, the price of gold went from a little over 300 to 850, and the margin on the top 10 gold producers did not expand at all. It did not change at all. Price of gold more than doubled, and it didn't change. Now, we've got a very interesting situation now. The two largest cost inputs for mining, number one is energy, and of course, we've got a historically low oil price right now. And number two are the commodity currencies, the currencies where you have your mine. That accounts for the labor costs, all of the local stuff, building your housing for workers, all of that kind of stuff depends on the strength or weakness of the commodity currency. And right now, although these currencies have moved up, they are still, on a historical basis, very, very cheap. Some of them extremely cheap, South African rand, Brazilian real, but even a Canadian, Australian dollar, which have rallied in the last months, are still significantly below where they were back in 2011. What that means is that at least for the time being, because it will change, but at least for the time being, the gold mining companies are really in a sweet spot with higher prices of what they're selling and low prices on their costs. I'll skip over the losses and the debt for a second. This is just a graph showing you the exploration budget, the global exploration budget, now this is all non-ferrous metals, but about 2/3 of this is spent on gold, which is kind of surprising when you think of the size of the gold market relative to the size of other metals. But the gold market is very, very fragmented. If you look at nickel production or iron ore production or copper production, you know, the top 5 companies account for anywhere from 50 to 80% of global production. That's not true for gold. There are a lot of smaller gold producers and even more gold exploration companies who are all spending money looking for gold. So even though, as I mentioned, even though the budget has not gone down, we're just not finding the metal. And this shows you, this graph shows you, it's a bit messy, but look at the blue bars. The blue bars show you the number of discoveries. And I think even more compelling is the red line, which shows you the number of ounces discovered. Now, so in the last 5 years, this stops at 2014, unfortunately. But it really hasn't changed in the last couple of years. The discoveries that we are getting are smaller discoveries, and that's really significant. Now, I should point just one thing out, which is by its nature, if you think about it, I need to point this out in case anyone's paying attention. When you think about it, if you make a discovery in 2011, right, the ounces at that discovery are likely to grow over the next few years. So the discoveries that we had in 2010, 11, 12, 13 are probably going to, not probably, they will eventually have more ounces in them than this graph shows. So the ounces discovered is always running a little bit of a lag to the actual discovery. But notwithstanding that, I think the trend, as I mentioned, is pretty clear. And we had a peak in gold discoveries back in 1995. 20 years later, we had a peak in gold production. We had a mini peak in 2006. So we'll probably get a little bit of a pickup in gold production in 2024, 2025, 2026. And then I would venture to suggest it's going to pretty much drop off a cliff after that. This shows you the return on equity. This is, sorry, I'm still on my theme. If I'm jumping around, I am. There's a lot to talk about. This is a reflection of how difficult gold mining is, all right? So even though we've had a stronger gold market for all of 2019, frankly, I mean, it only pales compared with what's happened in the last few months. But 2019 was a very good year for the gold market. And yet the precious metal mining companies had a return on equity of only 3%. Only 3% compared with 13% for the market. And the market excludes financials, which are in a league of their own, or in a world of their own, I should say. League suggests somehow they're better, but in a world of their own. So this is a pattern you see year after year after year. I look at this, it's calculated in January every year. I don't think I've ever seen it. I don't think I've ever seen it where precious metal mining is even close to the market. And here's something else for you. Over the last 50 years, the gold mining business worldwide, gold mining industry worldwide has lost money. It has been a net consumer of capital, not a net producer of capital. And that, of course, includes periods when the oil price was $5, when gold was $1,900, et cetera, et cetera. Its long-term record for returns on equity employed is second only, and I'm talking about how bad it is, it's second only to the airline industry, which I think gives you an idea of just how bad it is. So for the gold mining companies to be earning 3% on equity is actually one of their highest returns. And that's part of a problem with mining. It's just a difficult business. So what do we do about that? Because, gold mining, as I say, it's a bad business. When you think about it, you have very high capital costs. Well, first of all, you have very high costs to find anything with no return. Then you have very high capital costs, and those capital costs are before you even start to produce, right? Your mine is located in one area, so it can't be moved. It's not like a widget factory, but if the government gets acquisitive, you can just move your widget factory somewhere else. Once you've built your gold mine in the Congo, you have two choices. Basically, you either continue mining in the Congo or you close down. I mean, you can reduce or, but you can't move that gold somewhere else. So mines are a wonderful target for cash-strapped governments. And so if you think about, and then when you actually do produce, you have no control over the price of your product, and your cost inputs are likely to be continually going up. That is not what I would call, if you're a business school designing the ideal business, in theory, that would not be the ideal business. Now, one way to avoid this is to invest in what are called the royalty companies. I'm a big fan of royalty companies, and essentially, I'm sure most of you know what they are. They've been around in the oil and gas business for decades, but they're pretty new to the gold mining business. But essentially, a royalty company will give money to the mining company. It might be while they're exploring, it might be while they're developing, it might be part of a capital cost of bringing the mine into production, it might be to repair a balance sheet, for example. But they will give money to the mining company in return for a part of the gold they produce, a royalty on the gold they produce. Most royalties today are net smelter, not net profits, which means I take my gold, my 1%, 2%, I take my gold off the top. It doesn't matter to the royalty company. When I say it doesn't matter, I exaggerate. It doesn't matter to the royalty company whether you, the miner, are making money, losing money. It doesn't matter to me whether the government of Tanzania wants to increase your tax rate, or the local workers go on strike, or the environmentalists are hammering you to close down. So long as you're producing your gold, I'm getting it off the top, even if your costs are going up. And so you can see on this table quite clearly that royalty companies have an advantage relative to ETFs, which invest in bullion, because the ETFs don't have that leverage to gold. They go up when the gold price goes up, they go down when the gold price goes down, but they don't have the leverage. And yet, compared with mining companies, they don't have the exposure to capital costs, operating costs, environmental costs, etc. So they really are, in many ways, the best of both worlds. Now, of course, you pay for that, and the valuations on royalty companies tend to be high, trading at like 60 times earnings and 30 times cash flow. They tend to be high. I can justify those valuations, but you're very, very rarely going to find a royalty company selling at a bargain basement. But I think as a cornerstone of a portfolio, they are difficult to beat, and they have lots of leverage. They have leverage to the gold price, in the sense that as the gold price goes up, more of the mines on which they have royalties will come into production for no additional cost to the royalty company. So there's lots of leverage in new discoveries, new expansions, increased production, and so on. Excuse me. They have the upside But they also tend to be, as companies, as a business model, they tend to be extremely low risk. This table, I mean, it's quite sort of plain, but the gold price goes from 1600 to 1800. Your operating costs in the current environment, right, because of oil and the commodity currencies, stays flat. Your profit margin goes from 33% to 50%. This is a sweet spot for the mining companies. It's not going to last, but it's a sweet spot. Of course, COVID has hurt many of the mines, and it varies from company to company. You know, if companies are heavy operators in Latin America, they've been subject to more shutdowns than, say, Agnico Eagle, which is one of the top 10 gold mining companies, most of whose production is in the Arctic Circle, both in Canada and also in Norway. So their mines have continued to operate. I mean, they had 2 weeks shutdown or whatever, but they've continued to operate. Their production really shouldn't go down very much when it's reported, whereas companies with lots of operations like Yamana in Latin America have been hurt a lot more. And that's the end of my presentation with my little disclosure here. Well, not mine, my compliance officer's disclosure. And I'm more than happy to take any questions that anyone has.
Very good. Thank you very much. That was quite informative. I would have to ask of you, just as an initial question, because we've definitely got some hands up, and for everybody else, if you'll raise your hand would be great. You know, over all these years, you know, with gold's always been very solid, like you show, it's even becoming scarcer, as it would appear. Somehow, why is the Fed and all those central banks been able to keep everybody so enamored and bought into that mentality, and not really understanding this continual underlying problem that, you know, one day those are going to come home to roost type of a thing?
Yeah, that's a huge question. I mean, I think there's two parts to it. One part is, you know, gold is sometimes called, by me anyway, it's sometimes called the anti-Fed, the anti-central bank asset. So for the Federal Reserve and other central banks have to ignore or dislike gold, because gold moving up is the people voting on what they think of central banks. It's an indicator. You can't have a lot of trust, and frankly, I'm surprised that trust in central banks is still as high as it is. But you can't have the sort of situation where Alan Greenspan was on the cover of Time magazine as whatever, the maestro, and, you know, the second most important man in the world. You can't have that at a time when gold is going up. The two don't work together. I think part of a problem with, well, first of all, there's an inherent problem in central banks and the Fed. I mean, I would abolish the Fed, and you know, people say, well, what would you do if you were appointed a member of the Fed? It's all right for you to talk. Well, first of all, I wouldn't do it, as William Buckley said. You know, what was it, William Buckley? Who was it who said, what would you do if you were announced a winner? I'd resign. But the first thing I'd want to do is get rid of the Fed, because inherently what they're doing is price fixing. Inherently, you can have better Fed people, you can have worse Fed people, but inherently what they're doing is anti-market, and that's the problem. But what's got worse in the last 25 years is the composition of the Fed. If you go back 50, 60 years, you actually, believe it or not, shock, horror, horror, you actually had businessmen on the board of directors of the Fed. Now, everyone on the board, everyone working at the Fed is an academic. There are people like Ben Bernanke or Jerome Powell for that matter, but Ben Bernanke with zero real life experience, zero. And so he comes to the Fed, rises through the ranks, becomes chairman, and he's never in his life had to deal with a business decision of your supply goes down, what do you do? Or I need to make a profit, how do I make a profit? There's no risk, and there's no risk for these people. Are you with me? They're not subject to the normal things that everybody else is, which is risk and reward. You know, if I make bad decisions, I get punished. My fees go down, I lose clients. If I make good decisions, hopefully people refer new clients to me and my fees go up. And it's the same in any business, right? There's always a lot of luck attached to it, but the point is the Fed is not subject to that. And I'll just, if I may, just finish with another truly astounding thing. The Fed, for the last 25 years, full of academics who've written these papers, and you can see this in the way they speak and the way they write papers. You know, their papers are 80 pages long, where, you know, 2 pages would really convey the message. After the Fed, for the last quarter of a century, has basically experimented. And I will give you a couple of clear examples of that. In 2009, when they decided to introduce QE and call it QE, quantitative easing, which was the first time quantitative easing had ever been introduced by any central bank, right? There was not a single paper from the staff outlining why this policy would work and why it might not work. At the board of directors of the Federal Reserve, there was, and the minutes have now been released, there was not one word spoken on possible unintended consequences. Not one word. 2010, when they introduced QE2, someone said, one of the people, Richard Fisher of Texas, asked if perhaps they should give QE1 a little bit more time to play out. And because they didn't really know the full extent of, you know, they didn't know the consequences. Ben Bernanke said, yeah, I know we don't know if QE worked or not, but we've got to do something. Now, to me, that is an astonishing way to run a country's monetary policy. We've got to do something. So anyway, I think it's part. There's so many factors that go into what you just said, but I think that's a few of them.
Well, the length of that response proves that for sure. Charles, I see you've got your hand up.
Yes, Jeff, and thank you, Adrian. Suppose someone seeing this video and worried about the possible collapse of the economy, they have some money, they want to hedge and diversify. 3 things for you. What is your minimum account balance to start? 2, what categories of investments are you going to put that money in? And 3, why?
Okay, well, thank you for the opportunity. First of all, we're not het up on minimums the way a lot of managers are. All I say to people is it's just plain got to make sense. So it's difficult for us to work with less than 50,000, to be honest with you. And I will also say to people that not because of any intent or anything, but larger accounts tend to do better than smaller accounts. And that's because with a larger account, you can afford to take a risk that you would not afford to take with the smaller account. And maybe, you know, 2 out of 10 of those risks go completely bad. So you're never going to pick one risk for a small account. But for a large account, you'll take 10 risks, 2 of them will go belly up, but you'll have 2 really big winners among those 10. So we're not head up. Is the one thing I would say is it's got to make sense for the investor, right? So a younger person starting out, we had one guy who just got his first job, gave us 20,000 and said he promised to add every quarter from his paycheck. That makes sense, right? But if you're 80 years old and you've got $10 million in the bank and you give me 25,000, it just doesn't make sense. We invest globally. So our accounts are, you know, can be global accounts, but tailored to the individual. not just in terms of the individual's circumstances and needs and future needs, but also what the person wants, frankly. If a person comes to me and says, I want to be entirely in gold and gold stocks, and I want to be only in junior gold stocks, so long as I don't think the person, doesn't know what they're talking about, we'll do it. It's your money, you choose. So we have global accounts, which can be aggressive or conservative, and we have gold accounts, which can be purely gold or can be gold and other resources. And minimums we're not overly head up about. Now, right now, I would have to say that even though the broad market's going up, and I can see very strong reasons for that to continue, we're being very, very cautious in the broad market. Very, very cautious indeed. So if someone came to me today, and I'll just say $1 million because it's easier to do the math. If someone came to me today with $1 million for a conservative global account, we would probably still have at least 50% of that in cash 6 months from now, unless something happens. And that's true. Accounts we got last year are still a lot in cash. Someone comes to me today with $1 million and says, I want a gold account. Even if they say to me, don't feel you have to invest all at once, Adrian, whatever you feel, we will probably have invested 75% of that money within a couple of weeks. I think first of all, I think the risk reward in the gold market is so much stronger today, and the opportunities in the gold market are still there. I mean, I'm very nervous about what's going to happen with second quarter earnings that are just coming out now. I think we're going to have some shocks in some companies, and that can always spill over to the broader market.
Is the election in the United States going to have any kind of impact, depending on which way things go?
Elections usually I would say, have less impact than most people think that they will. Now, I mean, to me, the number one thing that is driving gold, if we're talking about gold, the number one thing that's driving gold is Federal Reserve policy. That is not going to change one way or the other, whether the current people come back or the Democrats are elected, and they sweep the House or sweep Congress or don't, whatever. Sorry, I don't know which is better. So I don't think that's going to change. Now, one of the consequences but I mean, there's other things that are happening. I mean, the violence that we're seeing in different cities, which is certainly, if we had more time, I would argue why I think that is a direct result of Federal Reserve policy. But push that aside for a minute. That is definitely a factor supporting gold. And I think one would have to think that would likely get worse or continue if the Democrats won. The other thing that's important, can be important in the broader market, is where a new administration, or Congress for that matter, introduces rules that affect a particular industry. We saw this, of course, very, very clearly with President Kennedy back in 60, when he threatened the steel industry, and all of the steel stocks tumbled. One of the things President Trump has done that hasn't been sort of heralded is his reduction in regulation. The number of pages of the Federal Register, which is where all the regulations are published and is the way we judge how many regulations there are. He has reduced that by 30% since he came into office, which is significant. I mean, it's huge. It's been kind of unheralded, and it's all done by fiat. Just as the regulations are put in there without Congress knowing what's going on, they're taken out without Congress knowing what's going on. But a lot of those regulations have been extremely beneficial to the mining industry, oil and gas included, so the resource industry in general. So oil and gas, exploration, pipelines, drilling, permitting, it was getting to the point where even a modest gold mine in Nevada, if it was on federal lands, was taking 9 years to get permitted. And that's sped up under these changes in regulations from Trump. So that's been a positive. So if the other side gets in, and I speak as an Englishman and an observer, not as a participant in your politics, but if the other side gets in, likely would be some of those restrictions will be put back on and make it more difficult for the mining business. So I think those are the sort of changes, but I mean, a lot would depend on who he picks for his running mate. Biden, he's clearly not going to pick Elizabeth Warren anymore. But if he had picked Elizabeth Warren, that was the sort of thing that would have seen the market drop meaningfully. But I don't think at this point you're going to have a market crash, whoever wins. It's going to be more chipping away, as I've mentioned.
Okay, very good. Well, we've got time for one last question.
Oh, dear.
Unfortunately, we've been running along so fast. It's been great. I'd like to spend another hour. Anyone have a last?
Too much.
No. It's been very, very informative. Any last question there before
I think Sam
here?
has a question, Jeff.
Oh, okay. Go ahead, Sam.
Hey, Adrian, that was just fantastic. My son and I we dabble in options for fun together, and we've been following NUGT, a mining stock, and it's up 45% in the month of July. Of course, we've been playing the short 2-week suicide calls, but you have to watch it every day. But anyway, what's intriguing is I understand the United States holds the most gold in the world of any country, and why wouldn't we go back to a gold standard and sort of short the world when we have the most gold to back the dollar?
Yeah, I mean, that's an excellent question. I don't think we have time to go into the whole thing. I mean,
okay.
One thing is that arguably with the huge expansion in the money supply, not just of the US, but of every country around the world in the last, in the last century, there isn't enough gold around for a rational price to gold. You'd have to move the price of gold up to like $10,000 an ounce. Now, it was one thing for Roosevelt to move from whatever it was, in 33, to move it up 20% or something. But to go from 1,900 to 10,000 overnight might be just a little bit too much. I don't think
that would cause inflation, though, right? Wouldn't it be inflationary?
Oh, it would. I don't think. Well, the gold standard in and of itself is not inflationary, of course. I mean, there's huge misunderstandings about the gold standard. If you look at the record, in Europe, in America, since we came off the gold standard, in terms of we've had bigger depressions, we've had deeper recessions, we've had more inflation, not just the 1970s inflation, but the 1920s. You've had depressions in 1920 and 1930s, of course. You've had far more economic dislocation without the gold standard than with the gold standard. But I don't see it coming back. If I may just make one quick point on options, and obviously you're buying calls, which, as everybody knows, that's a bet on the fact that the price of the stock or whatever index is going up.
Right.
We do a lot with options, but typically what we do with options is selling puts. And selling puts is obviously a much more conservative way of going about it. But the beauty of selling a put, if you sell puts on things you don't mind owning, the beauty of selling a put is that whatever the outcome, you win. You either have a stock that you want put to you at a lower price than you would have bought it originally, or you simply pocket the income and do it again. Now, we tend to do that in flat or declining markets. So in the broad market, we're selling puts right now, but in the gold market, obviously you don't want to put $50,000 aside to sell a put on something, pocket $2,000, but miss a 30% upside move in the stock. So in a strong market, you know, in a strong market, we tend not to do that. But in a flat market, it's a perfect strategy. Anyway, I'll leave it at that.
Oh, that's very good.
Okay.
And unfortunately, we have to leave it at that because we're really here at the end. So I definitely appreciate you taking this time with us today. What I wanted to then also do a little bit here on the back end real fast is just to kind of show you, we will be debuting some additional information. This is one of the other sponsor sites, but you'll see here we had a nice little write-up on past guests, who's coming up, and so on. So you'll see we had an awful lot here. Adrian had his little write up here, and we'll be posting videos and so on here besides all those other channels. And there's other things you'll find on this particular site as well.